Right now, somewhere in a building most people could not locate on a map, a small group of unelected officials is making a decision that will affect the price of your rent, the cost of your groceries, and the value of every dollar, pound, or naira sitting in your bank account. You did not vote for them. You cannot remove them. And most people have never heard their names. Most people believe governments control money, that presidents and prime ministers decide how the economy runs. That is what the civics textbooks say. It is not how the world actually works. Today on Wealth Map, we are mapping the real architecture of financial power, the institution that sits above governments, above markets, and above the decisions of billions of ordinary people, the central bank. And by the end of this video, you will never look at your money the same way again. Here is something that will reframe everything. Central banks were not created to protect you. They were created to protect banks. When the United States Federal Reserve was established in 1913, it was not born from a desire to stabilize the lives of working Americans. It was born from a secret meeting of the most powerful bankers in the country on a private island off the coast of Georgia called Jekyll Island. Their mission was simple: create a lender of last resort that would prevent banks from collapsing when they made bad decisions. The system was designed by bankers for bankers. The fact that it occasionally benefits ordinary people is a byproduct, not the purpose. Understanding the single fact changes how you interpret every central bank decision you will ever read about for the rest of your life. Now let us talk about the interest rate, because this is where central banks touch your life most directly and most invisibly. When a central bank raises its interest rate, it is not just adjusting a number on a spreadsheet. It is pulling a lever that affects every corner of the economy simultaneously. Higher rates mean banks charge more to lend money. Businesses borrow less. They hire fewer people. Some close. House prices fall because mortgages become more expensive. Consumer spending drops because credit cards cost more. The entire economy slows down, deliberately. Lower rates do the opposite. Borrowing becomes cheap. Businesses expand. Employment rises. Asset prices climb. The economy accelerates. One decision, one number. Every business, every mortgage, every salary, every investment on earth touched. The Federal Reserve in the United States sets this rate approximately 8 times a year. When they meet, global markets hold their breath. Currency traders in Tokyo, property developers in Lagos, pension fund managers in London, all of them waiting for one announcement from one building in Washington, D.C. But the interest rate is only the beginning of how deep this control goes. In 2008, when the global financial system collapsed, central banks around the world deployed a tool most economists had only theorized about. They called it quantitative easing. The public called it printing money. Here is what actually happened. Central banks created new money electronically, not physically printed, simply added to digital accounts, and used it to purchase financial assets, government bonds, mortgage securities, corporate debt. Between 2008 and 2022, the Federal Reserve alone created over $8 trillion this way. $8 trillion. Now here is the part they never explained clearly on the evening news. This money did not flow equally to everyone. It flowed first into financial assets, stocks, bonds, property. The people who own those assets, overwhelmingly the wealthy, saw their net worth surge. The average worker saw their wages stagnate while the cost of housing, built on those inflated asset prices, rose beyond reach. Quantitative easing did not cause inflation equally. It caused inequality first, and the evidence for this is written clearly in the wealth gap data of every country that deployed it. This was not an accident. It was the predictable consequence of a system designed around asset protection. Now consider this. And this is the fact that most people in the world have never properly confronted. The United States Federal Reserve does not set monetary policy for America alone, because the US dollar is the world's reserve currency, the currency in which most global trade and debt is denominated. Federal Reserve decisions ripple through every economy on earth without exception. When the Fed raises rates, capital flows out of emerging markets into US assets. Currencies in Nigeria, Brazil, Turkey, and Indonesia weaken. Import costs rise. Inflation spikes. Ordinary people in countries that had no vote and no voice in that Washington meeting feel the consequences immediately. This is the hidden architecture of global financial power. One central bank, one currency, 195 countries affected. And now that architecture is about to change in a way that most people are not prepared for. Central banks around the world are currently developing what they call central bank digital currencies, CBDCs. Unlike physical cash, a CBDC is fully traceable. Every transaction recorded, every movement of money visible to the issuing authority. Proponents say this will reduce crime, eliminate tax evasion, and make financial services accessible to the unbanked. These are not unreasonable arguments, but consider the other side of that ledger. A government that controls a fully digital currency can, in theory, program money to expire if unspent. It can restrict purchases to approved categories. It can freeze an individual's financial life instantly, without a court order, without a bank involved, without any of the friction that currently makes financial control difficult. Over 100 countries representing more than 95% of global GDP are currently exploring or developing CBDCs. The era of programmable money, money that can be turned on, turned off, and directed by those in power, is not a distant speculation. It is already being built. Central banks are not villains. They are not a conspiracy. They are institutions, built with a specific purpose. And that purpose has always been more about systemic financial stability than individual prosperity. But understanding how they work, what they control, and where they are heading is not optional knowledge for anyone who wants to navigate the modern world with clarity. Most people spend their entire lives moving money they do not fully understand through a system they were never taught, controlled by institutions they cannot name. That ends here. This is WealthMap, and we are just getting started. If this gave you something your school, your bank, and your government never did, subscribe. The next map reveals something even fewer people know.